Hi, I'm Brian Cordes, head of the Portfolio Specialist Group here at Cohen & Steers. In 2020 and potentially years to come, investors are faced with the dual challenge of finding income in a historically low-yielding environment and protecting that income from taxes. In order to meet this challenge and others, one asset class we've seen all types of investors turn towards is preferred securities. Preferreds are being viewed as a potential solution to these challenges for four main reasons. One, they provide a high level of after-tax income. Two, they're generally issued by high-quality corporations that currently exhibit attractive relative value. Three, preferreds is a large global institutional universe. And four, have proven to be good diversifiers over the years as well. I'm going to go through each of these reasons now in greater detail. First, high after-tax income. Preferreds are hybrid securities. They have characteristics of both equities and fixed income. And while the preferred holder will hold a prioritized claim to assets and dividends over the common shareholder, they are subordinate to other creditors within a firm's capital stack. And because of that, preferreds tend to have higher yields than bonds with similar credit ratings. In addition, the majority of preferred income will be treated as qualified dividend income, or QDI. QDI is taxed at a top rate of 20% versus a top rate of 37% for ordinary interest income. It's this combination of high income and QDI treatment that creates the potential for superior after-tax income in preferreds, even relative to municipal bonds. Two, preferreds are issued by high-quality corporations that currently exhibit attractive relative value. Preferreds are mainly issued by highly regulated and/or stable cash flow businesses like banks, insurance, and utility companies. And I think it's important to note, given the environment that we're in, and that banks are the largest issuers of preferreds, we believe banks can be part of the solution to this COVID-19 induced recession. Banks all around the globe have been working with governments and regulators to ensure they're able to support the needs of households and business owners that have been negatively impacted by the pandemic. And while we do expect bank profitability to weaken, we expect them to remain profitable. That, combined with their very healthy capital levels, leads us to believe that it's very likely banks will be able to maintain their preferred dividends. When assessing value in preferreds, one way of doing so is by looking at yield spreads, looking at where they are today versus where they've been historically. When doing so versus a 10-year treasury or investment-grade corporate bonds, what we find is that preferreds currently provide attractive relative value. Third, preferreds is a large global institutional universe. The preferred universe as a whole is about $1 trillion in size, with a little bit more than half of the issuance coming from outside of the U.S. borders. Within that universe are two different markets. We have the $25 par market, where securities trade on the stock exchange. Those securities are readily accessible by individual investors. The much larger market, though, is the $1,000 par market, or institutional preferreds. These securities trade over the counter and are not as readily accessible to individual investors. As an institutional manager, Cohen & Steers can provide access to these securities. And this can provide benefits to investors. Historically, the institutional preferred market has outperformed the $25 market. You could potentially generate higher yields, and they have more advantageous structures, which can lead to less interest rate sensitivity. Fourth, diversification benefits. Historically, preferreds have exhibited low correlation to both equities and fixed income. In addition, a sector breakdown of the issuers in the preferred market will look materially different from what you would see in the broader fixed income market. This has led preferreds to being a good complement to investment portfolios over the years. In fact, if you go back 10 years, had you allocated 15% to preferreds as part of a fixed income portfolio, you would have enhanced your risk-adjusted returns. Similarly, a 50-50 split between municipal bonds and preferreds also would have led to enhanced risk-adjusted returns. Now, this catches many folks by surprise, but the reality is the default rate in the preferred market, like the municipal bond market, historically has been quite low. So in summary, with preferreds, we have an asset class that can provide high after-tax income paid by high-quality corporations that currently exhibit attractive relative value from a broad global institutional universe that historically has enhanced risk-adjusted returns. It's for these reasons that we believe preferreds provide a compelling investment option for today's market environment.